please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Taimur Baig, Managing Director and Chief Economist of the DBS Group, joins us to give us his perspective on all these issues. Well, first up, Taimur, let's start with the global scenario. 2.93 on the US 10-year and very confident statements on growth. Is the tone looking like 4 hikes from the Fed? And if it is that, how will the markets respond in the days to come?
Thank you, Lata. Good to be on your show after a long time. I would like to cast this discussion in the context of volatility measures. So if you look at bond market volatility from options prices, or if you look at the VIX, looking at the equity market action over the last, say, 4 years, you would notice that around the election of Donald Trump, there was this big pickup in bond market volatility. Expectations were that there would be tax cuts and fiscally aggressive policies which would lead to more debt issuance. But that sort of died down over the course of last year. It's back on right now. And it's back on precisely when equity market volatility has picked up too. Now, this rise in VIX and rise in options-based bond market volatility is a relatively rare event. If you look at the last 4 years, one or the other have taken place. They have not really taken place together. So what is this telling us? It's telling us that maybe the equity market went ahead of itself in the valuation side. So there is some volatility around the sell-off and bottom fishing. On the bond market side, I think it's the Trumpflation trade back again. We are now looking at a late cycle in the U.S. when both fiscal is and monetary are perhaps a bit too exceptionally supportive of the economic momentum, which the bond market's view is that inflation will take up anytime soon. So now to go back to your question, does this mean that 4 hikes as opposed to 3? I think the Fed would still rather be at 3. They're actually kind of pleased that the market's pricing of the expected hike is now more or less in line with the dot plots for 2018. Okay. And I think that March likely, June likely, but after that we'll have to see. I personally don't believe that there's a massive ugly rise of inflation in the pipeline that would justify significantly higher than 3% bond yield. So I think we are probably at the top end of the pricing end of the coming action.
Okay. They say that, and this is a broad question, but a rise in inflation essentially eventually kills bull markets. Are we at that point, I mean, overall, when you look at things, or do you think this is a short-term move and we are not at those levels right now?
Again, so what is the market saying in terms of treasury pricing or the inflation index bond? It's saying that there is a generalized likelihood that inflation will be higher tomorrow than it was yesterday. But when you look at this in the context of the last 5 years, inflation expectations are still exceptionally well anchored, and there isn't any runaway event in the pipeline, whether it is from wages or prices or further fiscal or monetary policy that might make one to believe that, additional inflation is in the pipeline. Already, given the volatility that we've seen in the markets in the last few weeks, it has taken away one key quick driver of inflation, which is oil. And this is, of course, music to also India's ears, because oil was turning out to be a bit of a spoiler in the first few weeks of the month in January. But now with oil sort of, well-behaved in the low 60s, I think we can live with that not being a source of major inflationary pressure. The key question, both for the market and policymakers, is the following. As labor markets tighten, as wages pick up, would the third peg follow, which is a pickup in prices? I don't think that link is very well established yet. We are in a very interesting phase of technological disruption in our economic history, where prices are not showing the sort of inertia that they used to show in the past because of the Amazon effect. So maybe even if there were wage increases, we may not see concurrent price increases, and therefore maybe inflation is not going to jump as much as we fear, and maybe the central banks don't have to react as aggressively as some of these markers are suggesting.
Okay. Well, there could be an argument that bond yields are jumping because they don't want to buy the huge supply of bonds expected from the Trump administration. But let me keep that dialogue aside. I take your point that you don't see, at the moment at least, the rise in yields to be too sharp, and certainly not sharp enough to impact global equity markets. But let me come to India. Here, it's not just inflation, but a serious aversion to buying bonds that's pushing up yields. Where do you see Indian yields now?
So, Lata, it's been a slog, no doubt about it. I mean, when you talk to foreign investors, they remain favorably predisposed toward India. They're not looking at, again, inflation being a spoiler. And I think, whenever the auction quotas are opened up, we probably will still see real money flow to India's bond market. So I don't think the issue is external interest or external concerns about the macro. It's really a domestic driver story here.
Yes.
I mean, we're talking about fiscal slippage, we're talking about banking system stress, and perhaps some sort of a fatigue on the flow of fund side as well, which has been very, very buoyant over the past year or so. Now, is there a set of news in the pipeline that could buoy market sentiments? I don't think so. I don't think, between now and March or April, nothing on the fiscal side is going to come out as pleasing to the market. You just alluded to the GST data. This has been my long-standing concern. I used to come to your show 2-3 years ago and used to sound, warnings about GST implementation, and you can see how challenging it is turning out to be. But even beyond that, overall, the trade deficit widening and various possible restrictions on ECBs, I think all of those are casting a shadow on fundraising, external or domestic. As an external currency or domestic currency denominated. And therefore, I think the risk is asymmetric. The chances of yields rising, I think, is much higher than real yields falling, even though we're not particularly bearish on the inflation side.